Good morning to everybody. I have this screen. Today we talk about global investing options, and this is something that I guess may be new for some of us, and some of us may also be doing it a little differently because we may have, say, mutual funds that we may end up using, say, Indian mutual funds, which also have exposure to Nasdaq and stuff like that. So this time I will sort of focus on options that are actually dollar denominated. Okay, so to give you a fresh flavor of things, I will focus on dollar denominated options, and I hope it's going to be a bit of a learning for all of us. The objective is to capture, the whole range of options that are there. This is not when we capture it, it's not necessarily a recommendation for you, but to just give you a flavor of it. For each of us, we need to look at what is appropriate for us. We need to understand risk level, and then possibly only, get into investing in, any global investing options. So before we start, okay, I wanted to, run a bit of a poll, and so I'm not clouding you with, my points of view. So, Tara, can you just run the poll on basically, have you invested in global assets before? Yeah, we have a reasonably good participation. I'll give maybe a few seconds so that, anybody who would like to participate in the poll, we can. Okay, I think that's good. So maybe we'll end the poll here. Yeah, and what's interesting is we have almost like 33% of us have invested in global assets before. Um, but what is interesting is a lot of us, over 58% has not, and we have about 9% of us who are considering it. So thank you for participating. I will go to the next poll. Okay, so Tara, again, the next poll. What percentage of assets will you ideally like to allocate, to global assets? Okay. So again, we have very good participation. We'll give a few seconds for people to complete. Okay, thank you. I'll just publish. We have about 53% of us want to invest 0 to 10%, and 37 want to invest 11 to 25%. And, you have the others who are, 5%. Okay. Both 26 to 50% and above 50%. So it's interesting. Okay. So clearly, I would think that there is interest, right? And for us to actually go back and invest into, global assets. And so with that background, let us start. Okay. Yeah. So what are we trying to do today, right? So basically, we're trying to, look at why should we look at diversified global assets? Why is it diversification required? We understand what is multi-asset allocation. Within global assets, why is it important to have multi-asset allocation globally as well, not just sort of in India? And what are the benefits and risks of global investing? Okay, and we will also go back and look at, is it important to align with your goals? We'll also capture as part of it a whole lot of indicative options. It will go a little bit in detail and come back at the end, where, should you look at rebalancing, should you review it? And then we'll also, have a bit of a conclusion out there. So broadly, why global diversification? Broadly, it's about, when you're domestic only, right? There are two things that happen. One is you're limited to, investment opportunities within your own country, right? Now, there may be a whole lot of opportunities which are outside, and they may be higher return, they may be lower risk, etc. That is something that is there. You may have a whole lot of new global growth avenues as well. Okay, you may be able to, today we are talking about pre-IPOs in India, right? So you may say, okay, I want to look at, maybe global investments like Perplexity. Okay, interestingly, that is one of the, investment options which is available today, right? So, and that is, right at the forefront of innovation globally, right? So if you want to invest in options like that, then you have newer growth avenues. The Indian markets may not have the breadth that you would like it to have. Okay. Of course, the other part of it is about diversification also helps reduce your portfolio risk. Okay, and when you're sort of reducing your portfolio risk, you're doing it because markets. Even if I look at equity, right, and if I look at, let's say, I'm investing in Indian equity, I'm investing, let's say, in US equity. Typically, you'll find that emerging markets and developed markets, many times move differently. There are phases when emerging markets do very well. There are phases when developed markets do well. So you want to have that diversification out there and use it to reduce your portfolio risk as well. And the last is, when you do that, you also are building long term wealth creation. Okay. Of course, one important consideration for a lot of us, and when we are saying also wealth creation, is about the currency, right? When you're looking at diversification, one of the risks that you're also trying to address is currency risk, right? And for many NRIs, right, they have seen the rupee really depreciate significantly, and there's always an assumption that maybe the rupee will continue to depreciate. And so when you are across two different jurisdictions, when you have two different currencies, okay, even if, let's say, the asset class does worse, let's say in the US, you may find the appreciation of the dollar may be there. Now, the point to keep in mind with all of this is sometimes we are looking at it, with a rear view mirror. Right. So the dollar has appreciated and the rupee has depreciated over the last few decades, right? But you need to keep in mind there are periods when the rupee has also appreciated, and the periods can be as much as 3 years, 5 years, and you may find that over almost 10, 15 years, the rupee would have appreciated, depreciated, and been at the same place. Okay, so there have been live cases where over a decade and a half, you found that the rupee, the currency, has not, depreciated much. So that is something that it is not such a simple, thing to say that, okay, you will always have dollar appreciation as you go forward. That's just a caveat, because we think that, some of it is likely to change, but dollar is not the only currency, right? So you may go back and invest in euro. You may invest in Singapore dollar. You may do various other currencies. Where if the view for the US dollar say is negative, right? And one is we spoke of diversifying across countries, but the other is what we believe is the ideal way to invest in global investments also, is to look at multi-asset. Okay, like the ideal thing, like what you do in India, you have your asset allocation across equities, bonds, real estate, commodities, right? And today you have alternatives as well. Okay, so you want to diversify across it, not only for your assets within India, but you would do it, for assets outside. Now, what is it that you will do a little differently when you look at global diversification? If you are based in India, you may not, look to allocate too much globally, right? So if you're keeping, say, a 10% or 15%, even a 20% globally, then it may not make sense, to be completely all over the place and fully diversified across all asset classes globally, right? So you have to look at, say, within global assets, maybe which are the ones that you are not able to get in India, and possibly those are the ones that you prioritize. But it's not good to be only in one place. Okay, I think many of us have invested through, say, Indian mutual funds globally, and the only thing we've done is, say, invested in a Nasdaq ETF or a Nasdaq fund. Now, the issue with that is, you are taking a bit of a concentrated bet there, right? And if that pans out well, then it's good for you. But in all probability, once the cycle turns, it may give away. So what the point that we are making is, yes, take some of those bets, but don't have it only in one place. Have multiple opportunities that you can look at across multiple assets, and that's why we're saying that multi-asset allocation sort of is important for us. It definitely reduces the risk for you. It balances and helps. It may also help you get a higher return, because there may be some options that actually give you a higher return on there. And it's reduces the reliance only on a single market. Okay, because there may be points, let's say, and you look at a country like China, right? So there may be points like that where it has done very well in the recent in a certain period of time, but then there could be underperformance for an extended period of time, right? So in situations like that, having global investing options then really, uh, allows you to go beyond your country when, if that is an outlook that comes across at some point of time, right? And definitely, diversification globally adds another level of portfolio stability, right? Now, typically, what are the assets that we should include? Okay, I think uh, if you go back and see globally, when you look at equities, ETFs has become the standard. Okay, yeah, ETFs are basically exchange traded funds, and they are also low cost. Okay, and especially in developed markets, cost optimization becomes very, very important because the overall return may not be really large. There are periods of time when it may be large, but if you look at extended periods of time, the return may not be very large. The markets have become efficient, which basically means that it's difficult even for fund managers to outperform the market. Okay, and which is why when you see a scenario like that, then you'll say, okay, when active fund management is not able to deliver additional returns, then I'll say, how do I save my cost? So sorry. So ETFs have become a bit of a de facto, and low cost investing has become. In India, it may not be as prevalent because we are not yet as efficient a market. So you'll find that a whole lot of funds deliver substantially higher returns than the benchmark. Okay, so many of the ETFs are basically benchmark hugging ETFs, and to that extent, your active funds in India typically deliver more. Okay, but when you're looking at global, uh, ETFs are definitely a way to go. But the interesting part in global also is that ETFs are much more evolved. Okay, so which basically means that you may have a style which is almost active. Okay, so you may have, even in India, you have momentum funds and factor-based funds, etc., which have come out on the ETF side, right? So those are things which can have. In fact, you have ETFs which can be, which are unheard of in India. So it makes money if markets fall. You have where they take a short position. Okay, so there are leveraged ETFs which are there. So there are a number of things which today are not allowed within India within the regulatory framework, which things are developed much more globally. But of course, with that also comes higher risk. Okay, so you must just keep that in mind. So whenever you have leverage, etc., you may end up with higher risk. But you have to be aware that uh, you have to study your fund well before you invest. Okay. Of course, you have other funds as well, and we'll show you a flavor of some of the funds. Bonds is something that is there. Uh, there are periods of time when I know people would, buy the SBI bonds, let's say overseas, right? Because uh, at some point of time, the Indian government issued it, and it was at a much, much higher yield, compared to a global bond. Okay, and again, there also we'll go back and see a few options out there. So then you have commodities. Now the other part about in India is you basically have gold and you have silver, which has come at ETFs now. Okay, so of course you can go and play on the commodity market, but I mean that's a different ball game completely, because you are taking leverage and stuff like that. But I'm saying for a common investor, wanting to invest in say ETFs or mutual funds in India, you basically have gold and you have silver, right? And silver also is relatively more recent. Okay. When you go globally, you can go to and take positions in oil, you can take positions in copper, you may take in any material that you think is likely to do very well. Okay, it may be if something is linked to, like lithium was something that people found interesting because of its use in electric cars, right? So, of course, the point that I again want to highlight is sometimes the cycle doesn't play out as well on an extended period. And let me give an example of lithium itself, right? It did very well, and obviously, there was a whole lot of demand for it as the EV wave sort of hit in and kicked in. But there's some points of time when suddenly, over the last in a few years, lithium has actually not done well. It has been negative. Okay. So I'm just again, while covering it, also give examples and try to capture the risks also and give you a, a wholesome perspective, right? So uh, even with oil, right? So you have to be careful in terms of how you do. You may find uh, the depth can be even much larger. For example, which you don't cannot even imagine, right? Um, I know of some of the funds which invest only in water. Okay, so they invest in water. Some of the invest only in, let's say, certain energy. So the point I'm making is that you have options that which are far beyond, say, what you have within India. Okay. Obviously, you also have the private equity. I spoke to you about Perplexity. Okay, and as an AI company, that is drawing attention. I know in the past we had automation anywhere. You have a whole lot of private equity options which have come in. You have options of private equity funds. Okay, now you may invest in a Carlyle or any other General Atlantic partners, and they all have private equity funds. Yes, they may have a minimum ticket size which is larger, but some of the platforms that we work with actually what you call is fractionalize it. Okay, so you may have a smaller minimum because they put it together and they pool it and then they invest. Okay, so you may find for a fund like that, it may be a few $1 million as a minimum, but on some of these platforms, you may get it at between 100 to $250,000 or $500,000. Okay, for some of the more niche opportunities, but many of the other funds, again, which minimum maybe $100,000, etc. You may even get it at $25,000. Okay, so you have platforms that we can leverage to invest in some of these, even though say they may be at a larger scale. Uh, then and so the whole point I'm making is how do you look at investing which is complementary with your Indian assets, okay, and and that makes it better. It makes diversification and stuff. So I'll get into some of the details just to give you a little bit of a flavor. Like I said, this is not necessarily a recommendation for you to buy into some of these, and you can see we also capture the maximum drawdown. Okay, the maximum drawdown means how much has that particular fund or that investment fallen, okay, from its peak. Okay, so whenever it, let's say in 2008 you had a market peak, and if let's say the commodities peaked in October 2000, uh, so say Jan 2008, okay, from there to its low, right? So now let's say the equity markets in India say fell say about 60%. So that 60% is called the drawdown from the peak to the bottom in that particular cycle. Okay, so this is the commodity index. So when you look at it, some of it looks good. You will find that some of the gold miners ETFs have done phenomenally well. Okay, but if you see the maximum drawdown was 80%. Okay, so which means that it could have fallen from its peak at some point of time. Gold miners ETF has fallen 80% from its high. Okay, so that is something that sort of you keep in mind when you look at it. So commodities, typically when you invest into commodities, you have to be a little more nimble. Okay, so you need to see when you can come and go out. But I can say that for something like a gold, right? Because gold miners is a little, it's investing in gold mining companies. Okay. So that has a higher risk than even gold. It has a higher return than, okay. So you can see that 1 year, 57% return, right? So which is, and if you see typically the return will be higher than the just gold as a commodity. Okay. Because, of course, we've seen periods when some of these, companies get impacted, say, by various government regulation, right? If suddenly there's a tax that a government sort of puts in for the gold miners, you may find that their profit growth will get impacted by the tax, and then you may find it come down. the particular gold mining fund come down, even though say gold may stay where it is or it may go up. Okay, so that's just the point that I'm making. Gold miners funds are like investing in gold mining companies. It may be higher risk, but that is something to keep in mind. But commodities definitely globally has a lot more options. Okay, the other you have ETFs and just you have various funds which are there. Okay, again, I'm just giving you a flavor of them. Like you'll find some of them have delivered good return. And if you go back and look at, some of these 15, 18% dollar return is is very good because when you also look at it, versus the depreciation that has happened in Indian currency or relative appreciation of the dollar versus the Indian currency, if you are an Indian investor, okay, your returns are higher than this. And, that would have done well for you. Of course, keep in mind that you may see that, the max drawdown for equity is not as small as one thinks it is. Okay, it is volatile, but the question is if you are able to ride through it, then you probably are able to see this. So the point I'm making here is that while you're investing ETFs here, you can see, okay, I can invest in the US, I can invest in Japan, I can invest in Europe. Okay, so we just purposely showed funds like that. I may invest in a value fund, I may invest in a momentum fund within US. Okay, so you have options and flavors which can go far, far beyond. The ETFs is very, very large, play that you have, like I mentioned. Bonds are the other place that people come and you will find that. So again, I'm just giving you examples. You have our own Jaguar Land Rover, at having a bond at 7.75% is a 5-year return, right, in dollar terms, which is very good. And the yield, that you have on something like that is 7.75. And so you'll need to look at the yield to maturity, right? Rather than looking at the what is the return of the particular bond itself. Because like let's say I'm just saying for example Deutsche Bank, right? So Deutsche Bank is something like 7.05 the yield for an issuance at say 4%. Okay. So depending on interest rates and how things are moving, you may actually end up getting a better yield on it as you go forward, right? So you need to look at bonds accordingly. Again, bonds also are not as simple as it is, especially if it's also global. You need to be very careful about what is the credit rating profile. Okay, and you would want to invest based on that. So even a Bank of America says a A minus. Okay, so something that like that you need to sort of keep in mind, that if there's like a crisis, if there's a subprime like crisis and stuff like that, or you find that yields are, very volatile, and if you find yields like in the US had gone up, right, almost like, and at some point of time, inflation there had crossed 10%, which was very unusual. In those periods, you will find that there will be volatility on bond side, and you'll probably see negative returns, which is why it may be interesting to note that even on the bond side, and possibly because of this volatility that we've seen in some of these periods of time, a Bank of America bond, for example, had a maximum drawdown of 22%. Okay, not something you will expect for a bond or a bond fund, right? So that is, of course, even within India, you will find that if you're investing in longer dated bonds, okay, and if interest rates go up sharply, again, you will see capital erosion for a period of time. Even though when you hold to maturity, you will continue to get your yield. Okay, but intermediate, if I sell it because if interest rates have gone up, then somebody else who's buying it for me will want a higher rate of interest or what they call as yield than what I may have invested at. So if that happens, so for example, if I invest in a bond when interest rates were at 5% and it was 5%, but when interest rates say go up to 7%, okay, then you may find that I will have to sell my bond at a discount to give the other person 7% for the rest of the tenure. Okay, so that is something that we sort of keep in mind. You have funds. Again, funds. Now, this is what you like. If you see, if you remember when we went about ETFs and equity ETFs, right? The drawdowns and I'll go back there just to give you a sense of it. Okay, the least drawdown was 32%. Okay, in any of these funds there, but here you have funds which manage risk well. Okay, so you find that there are funds which have only a maximum drawdown of 8%, which is from any peak, it has not fallen more than 8%. Okay, so a fund which is sort of China focused, and we all know how China has not done well at all. You'll find that the fund has delivered almost like a 13.4% type of return, and this is a period when China has not necessarily done well, right? So you have some funds which manage risk well, who are more dynamic and stuff like that. Okay, and so that is something which is there. Now, now coming back to actually the one of which is on the top of the chart, 5-year return 61.82%. Okay, uh, why should all not be investing in that? Okay, so the point I'm making is, in fact, I don't even have what is the drawdown on it. You're sort of not able to find out the drawdown for the fund, but I can tell you that it's going to be very high, right? So, and we've seen some of the funds, for example, there were funds which were robotics funds, and there were funds which, you know, uh, were some of the technology innovation funds, which were very famous for a long period of time and delivered, crazy outperformance. Okay. But subsequently, for the last 3 to 4 years, those funds are doing very poorly, even though Nasdaq has recovered. Okay. So I'm just saying that past returns and past 61.82% returns is something that I will be very, very cautious about the fund. Okay, so that's just the limited point I'm making. While we invest into funds that deliver great past returns. So, so coming back to, one is giving you a flavor of the type of funds. Okay, so is it all good? Should we look at certain risks? Yes, definitely. And yes, what are the risks that one should be wary of? Okay, but sometimes currency fluctuations can be to your advantage. Like I said, in the past period, investing globally actually would have benefited you from. You were benefited from it. Okay. So that is something which is something that you should keep in mind. And uh, the second part is, you may have risks which are local to that particular country. Okay, which sort of you get impacted with. Geopolitical risks which are there. Suddenly you have change of head of the state, and we can see that there's a whole lot of activity happening around the world, right? So and if you are sort of you know investing into Ukraine, and you may find some very good assets, maybe because it has done very well, and it gets impacted by war, and let's say if you are in manufacturing and your factory just gets bombed, right? So I'm just saying that there are risks, there are geopolitical risks and regulatory risks that also may come in, not only just geopolitical. So that is something that one keeps in mind. At times, there may be liquidity constraints in some markets. Okay, and like even here right now, you're saying, okay, pre-IPO, we know of a few of the companies which were like in cutting edge. Okay, Automation Anywhere, for example, great company doing well. Okay, doing in an emerging area, very much required in automation, uh, and had a very, very well known software. But somewhere, it was supposed to come to IPO, they were not able to, and then you know investors had to wait for a couple of years. Okay, that's something that we keep in mind. So sometimes we may have liquidity constraints in some markets, and maybe certain asset classes as well. Okay, and uh, these risks, and how do you mitigate them, becomes important is the question. So it's clearly about how do you diversify, how do you try and understand market cycles, not just chase returns, because the best performing fund is was for somebody else, right? The past returns was somebody else's return. If you are investing now, okay, the only question for you is how does a particular company or fund do well going forward. And typically, you will find that at some point of time, wherever you've had excess returns, it many times gives away. Okay, so I'm just saying it's important to look at that. So not just past returns, you have to look at market cycles. You have to do your own due diligence. You have to ensure that you keep your risk metrics there. Study what is the risk of the fund. Now, the point to be noted there also, you may have a fund with very good risk metrics, okay, but it may fall because again, the risk metric is based on past data, right? There may be some other event which may just trigger particular company or a fund, okay, or for the sector, right? It may come back in impact, and so even though in measurement terms, if you measure volatility and if you say maximum drawdown, and if those are low, you may still it doesn't safeguard you completely from seeing a higher fall. Okay, so yes, in most cases, say the probability for you to not see, as much of a fall, comes down. Uh, you know, there, so you'll probably see it lesser, and it's one of the parameters that you try to do to evaluate what's a good thing to do. And the point is, while you're doing whatever you're doing on global assets, it's important to look at what are your goals, what's the risk tolerance. Again, I'll give an example on goals, right? If I have to send my children overseas, right, then I have a need for having global asset. Okay, it is for diversifying, it's for managing the currency risk. So normally I may not have the currency risk as much. I may do it for returns. But in a situation where I know that okay, over the next 3 years, 5 years, or even 10 years, I need to send my child overseas. Then I want to see how I can align it with my goal, right? So I may also say if I have my daughter's marriage and I want to plan a certain goal for her, okay, or my son as well, okay, then you can say, okay, I can use the Indian ETFs in India, but I can also use your ETFs globally. Okay, now sometimes there's an arbitrage which is there. Why? Because there was a much higher tax on gold for a period of time, and so you'll find that the ETF, let's say, which are overseas because of lower taxes, may have delivered a better return. Okay, so those are things that one keeps in mind, but so goals you also need to look at some of them where you may require or it may be good for you to use global assets. Okay, so that is something that sort of one can do. And I did emphasize that it's important to look at risk. I've given examples as well. That uh, you know what you see in the past need not be the return for the future, right? And which is why I'm saying it's important to, look at your risk appetite and understand your risk before you go back and invest in some of them. And accordingly, customize your global allocation. Okay. So keep in mind some of these, keep in mind your goals, and then keep in mind when you need liquidity, etc. And then accordingly, you can end up investing in your global assets. And of course, you have to also revisit your goals periodically because circumstances change, and then as you get closer to your requirement, you're able to predict or project your requirement much better. Okay, and the other point that I would like to make is, can you invest? Okay, multi-asset, yes, it manages risk. I just leave it for forever. It's not. It doesn't make sense to do that. You have to keep relooking at what is the allocation at this point of time. I look at what is likely to the currency going to do. I look at what are various assets are going to do. What is diversification that I want? Okay, and accordingly, in my overall, it's important to look at both your local plus global asset allocation accordingly, right? And then you can sort of look at it. It's important to study market cycles because we've seen gold, for example, it did very well around the 2008 periods when you had the previous crisis. Okay, and then subsequently for a long period of time, gold underperformed significantly and did very poorly and sort of for a period delivered negative returns as well. Okay, but in recent times you're finding that it's done very well. So I'm just saying that you need to study market cycles. You need to study for just saying for example, okay, in the past few years, Nasdaq has done very well. Okay, at what point does the particular cycle get over? It will get over at some point of time, and that is when you lose out the most. Okay, which is why typically we don't like to get into cycles which are sort of mature. Okay, sometimes we say, okay, we missed it, let's move to something else. Okay, so that is something that you need to do and keep looking at data, rebalancing, and based on your asset allocation. And for NRIs, yes, like I did say that goals are something that you look at. For NRIs, again, you need to look at it because you may want to have assets globally, right? So it's not like in India that, it's a diversification, but there it may be money required for your needs, locally, right? So from that standpoint, you may actually say, if my expenses are in dollar denominated, I need to have my expenses, planned for. Okay, and if the currency doesn't do well, etc., okay, then I have to look at it. Yes, you also have to look at it if you're in India. Then you look at various regulatory frameworks. Even if they're in the US, many funds in many jurisdictions don't accept US investors, so you need to look at what happens, the taxes, is there a succession tax, etc. Okay, so all of those that you need to sort of look at. Okay, and if you also like to have assets in India, then it's maybe you're flipping it over. So you may choose to have higher global assets, and I think a couple of us put those numbers which are higher than even 50%. I'm assuming some of us may be NRIs. Okay, so and that's a good thing to do, right? So it depends on various perspectives. If you're looking to come back to India, you want to, your children are going to continue to study there, and various aspects that you see. Then even if, let's say, India is like to deliver better returns, you would want to diversify, right? And you want to manage this because most importantly, I think you need to manage your risk, have your foundation secure, and then you can build on, working towards, getting better returns. The repatriation rules, tax implications, consolidation, ease of tax filing, etc., that you need to sort of look at and plan accordingly. And uh, one wants to take your questions, so I will summarize here. And so basically, just a few points, okay, that I want to leave you with. A global multi-asset diversification is a good thing to look at. Okay, and it's good to start, working towards some global asset allocation, even if it's in a phased manner. Yes, you can always start with, mutual funds in India, with a global perspective. But then as you go forward, as your asset size grows, okay, it makes sense to diversify. You need to look at it, align it with your goals and your risk profile. If there are some considerations that require you to have more assets globally, like planning for your child education, then it is something that you can do or you should do. Okay, and you also look at multiple uh, vehicles or multiple asset classes. Okay, so that you are diversified and you're not putting all your eggs in one basket. And the last point I would say is, today you need to keep reviewing your investments on a periodic basis and seeing whether, you need to rebalance, you need to look at market cycles, etc., and then plan for your global assets.